Hello friends, today I am going to tell you how you can use Excel for historical data analysis. Historical returns are often associated with past performance of securities. We can identify whether and how stock prices has performed into various times into various situations. Investors study historical return data in order to try to forecast future returns to estimate how a security might react in a situation. Return we can calculate by deducting most recent price minus oldest price. That means by deducting selling price minus purchase price. Analyzing historical data can provide insight into how a security or market has reacted to a variety of different variables, from regular to economic downturns. But investors must keep in mind that past results do not necessarily predict future returns. The older the historical return data is, the less likely it will be successful at forecasting returns in the future. Each year's annual return is compiled to show the historical returns over several years. So, how we can calculate historical returns? How can we use Excel for determining whether it is right time to purchase the stock or sell the stock? So, to answer this question, whether it is right time to purchase the stock or sell the stock, we are going to use Excel because we know that stocks is a volatile market. It sometimes moves upward and sometimes moves downwards. After selecting a successful company, we can maximize our profit by determining the time of entry or the time of purchase of the stock. If we are able to time entry into the market or purchase of a particular company at right time, we can make a good profit. Otherwise, no matter which company you have selected, but purchased at higher price, you are not going to make profit. So in order to make profit, you need to know when it is the right time. Let's go and download the historical prices. I am going to use Yahoo Finance for downloading the historical prices. In Yahoo Finance, you can select any company. I am selecting Microsoft. It's provide time period. You can select historical data for 1 day, 5 days, 3 months, 6 months, 1 year, 5 years, or maximum. I am selecting historical data for 1 year, then apply and then download. Historical data containing CSV file is downloaded. It is showing 7 columns: date, open price, high price, low price, close price, adjusted close, and volume. We will be using only adjusted close, so others column we are going to delete. Let's delete the other columns. Let's increase the font size. Next, we are going to calculate return. First of all, let us see the row. Historical return can be calculated from subtracting latest price or our selling price, yesterday price or purchasing price. So we can calculate the return and then copy down the formula in order to calculate daily returns. So we can see that on some days we have made profit and on some days we have lose them. So by analyzing this data, we can say that on all days we cannot make money. So on all days we cannot invest also. In order to determine which day we are going to invest the money and which day are not going to invest the money, we are using average and standard deviation. We are going for simple moving average. Many sites or all of the sites provide average moving data. We can calculate average moving data for a period of time for 20 days, 50 days, 100 days, 200 days. we are going to take 50 days average moving data. And next we are going for extended range. So for last 50 prices we are going to calculate moving average. On 51st row we are going to apply the formula average from 1st to 51st. And then we are going to calculate moving average by copying down the formula. Next we are going to calculate extended deviation. Same for last 50 data we are going to calculate the extended deviation. Then copying down the formula to calculate moving extended deviation. After calculating the written moving average and extended deviation, now we are going to determine whether today is the right day to purchase the stock or not. So same golden principle we are going to follow. If stock price is less, we are going to purchase, and if stock price is more, then we are going to sell. The parameters we are going to take is moving average and extended deviation. If stock price is less than moving average and extended deviation, then we are going to purchase the stock. And if stock price is more than moving average and extended deviation, then we are going to sell it, or we are not going to purchase the price. We are going to apply the F formula, and we are going to denote 1 if we are going to purchase the stock, 0 if we are not going to purchase. Closing price is less than moving average and extended deviation, then we are going to purchase. If it is more than moving average and extended deviation, we are not going to purchase it, or we are going to sell it. So same we are going to apply the formula in all these cells. Now let's go to our recent entries. Now in last 10 to 15 entries you can see that 5 times their buying signals are there, and 6 times there are selling signals are there. So if we are able to determine this time, we can make correct decision and we can make profit. Let's format this cell also. For purchasing, we are going to denote it with red color, and for selling we are going to denote it with green color. You can also use graphical representation to make your decision. So we select all these data and make a graph. While analyzing graph also you can see that if closing price is more than average price, so we are not going to purchase because it is trading at a premium. And if closing price is moving below the average price, so we are going to purchase. So this is from my side. Keep watching more videos for more updates. In my next video I am going to tell you how we can use Python for algo trading. For more updates, please subscribe to my channel. Thank you.